Hello, everyone, and welcome back to Motley Fool Conversations. I'm Motley Fool contributing analyst Rachel Warren, and today I'm delighted to welcome Scott Sandborn, CEO of LendingClub, to the show. LendingClub is a prominent U.S. financial services company. They operate as a digital bank with over 5 million members and over $100 billion in personal loans processed to date. LendingClub utilizes an advanced data-driven underwriting model to offer personal loans, auto refinancing, and banking products. Scott joined LendingClub back in 2010. He's been a driving force in the management and development of the organization, with executive roles ranging from chief marketing officer to chief operations officer and president. Scott helped steer the company through a prolonged period of immense growth, running up to the company's 2014 IPO, which was the largest U.S. tech IPO that year, as well as the acquisition of Radius Bank in 2021, which helped cement LendingClub's transition from a peer-to-peer lending pioneer to a fully chartered digital marketplace bank. Scott, welcome to the show. Really delighted to speak with you today.
Yeah, delighted to be here. Thanks for having me.
Absolutely. So for those who aren't familiar with LendingClub, maybe to start off today, can you walk our listeners and viewers through its mission, the company's target customer base, and how it's evolved through the years?
Yeah, so I'll maybe start a little bit with the mission, which is what do we do on behalf of our customers? And what we do is we make it very, very easy for people to make smart financial decisions that result in either having a lower cost to borrow money, lower cost of credit, or a higher return on their savings and deposits. So that's what the company does. It really kind of flips the traditional banking model on its head, which was based all around, the way I get customers is I open a branch near their house, and then I take advantage of the fact of that convenience, if you will, to not offer the best possible product. And, so we're really supported by all the tailwinds, the growth of mobile, the move to digital, where now, we win customers by offering the best products and the best experiences. We started, way back in 2007 was our first loan. It was via an app on Facebook. With the idea that, hey, lending is a data problem, the customer experience is terrible, and a customer-obsessed technology, data-driven technology company would be well-positioned to solve this, and you didn't need to be a bank to do it. And that was mostly true, except for not needing the bank part. We have demonstrated now for, obviously getting close to 2 decades, real leadership in underwriting, our ability to assess risk, price risk, and deliver, broader approval rates than traditional models, offer lower pricing than traditional models, and still very, very compelling returns on the loans for people that hold them, including us. But we determined that having access to stable funding, bank balance sheet, deposits, really would create a much better business model and unlock our strategy. And so we acquired a bank in 2021, and it's really completely changed the company, not only financially, but also strategically in terms of what we can do for our customers, our ability to innovate, and grow the business over time.
Yeah, and that's honestly a perfect lead into my next question, because one of the really notable legacies of your tenure so far has been that acquisition of Radius Bank that really helped propel that transition from a peer-to-peer lender to a fully chartered digital bank. It was a very bold move that really allowed LendingClub to combine its digital marketplace lending with more traditional banking services. And as you mentioned, it's really kind of changed the model for the business. So I think it'd be interesting if you could kind of walk us through that business model transition and what that journey has been like in the years since to really integrate this new model.
Yeah. So we did it before it was cool, and as you know, there are dozens of companies now pursuing a similar path, not in terms of the strategy, but certainly the business model. So there are, the number of reasons why we pursued the acquisition of a charter was pretty vast. So first, just financially, we were paying a bank to issue loans for us. Which, we get to keep that money, and that was probably north of $20 million an annual expense. We were paying banks to warehouse loans for us at the time. Prior to becoming a bank, we did not hold any loans. We sold everything we originated. But people don't buy a loan a day, right? They want to buy a pool of loans, 10, 20, 50, 100, 200 million in loans. So we have to pool loans so that people can deploy capital efficiently. So we had warehouse lines, again, another cost to us, probably also north of 20 million in annual expense, which is replaced by the cost of deposits, so much, much lower. And then third, we had the ability to eat our own cooking, basically hold some of our own loans. And we earn roughly 3 times as much when we hold a loan versus when we sell it. So literally do the exact same thing we were doing before, except hold a portion of the loans. You eliminate very, very significant expenses, and you pick up a new revenue stream, which is resilient. So those are the financial aspects, and you can see in our results post becoming a bank, we really took off, record, became profitable the first quarter after acquiring the bank, and proceeded to deliver record loan volume, record revenue, record profit subsequent to that. That's the financial piece. On the strategic side, there's the ability to control our own destiny, have a direct conversation with the regulators about what our plans were and how we're planning to innovate, but most importantly, the actual ability to do that. One of the things that can get in your way of launching new products when you don't have your own balance sheet is you need to convince somebody else to take the credit risk when you're offering a credit product. So you say, hey, we're going to start doing auto refinance. Like, you love our personal loans, you should try our auto refinance loans. People say, well, show me your loan tape. I don't have one because I'm just starting. Well, okay, then you need to guarantee performance, or I'm going to buy at a discount, or both typically. And so it's very, very hard because you're burning capital until you establish a track record. And that's many years, right? And basically the more successful you are in that product launch, the more you're burning due to those upfront economics. So having a bank allows us to innovate, launch new products. It's also new features. The way it used to work, hey, we're moving into cash flow underwriting to unlock a new segment. We need to go to investors, say, here's the modeling we did, here's the math, here's why we think it's a good idea. Are you okay to buy it? The same conversation. Now what we do, we see an opportunity to innovate, we go do it, we put it on our balance sheet, we run it until we get a real idea of the performance, and then it becomes part of our standard public program. It's why we've been able to deliver such outsized credit performance versus the rest of the market. We release 5 years of data showing our delinquencies in like segments of credit that are 40+% lower than the direct competition. So, and that's because we don't just try stuff and see if it works. We season it on the balance sheet and then scale it. So it really unlocked that. And then the other thing it unlocked is the ability to take over the other side of the consumer's balance sheet. The consumers we're serving, we can now say to them, hey, in addition to lowering your cost of credit, we can also help you earn more on your savings, and really give them a holistic view. So we have a product called Level Up Checking that if you have a loan with us and a Level Up checking account, when you pay your loan from your checking account, you get 2% cash back off of your loan payments. And we have a high yield savings account that rewards good savings behavior. You get a top of the market rate if you engage in ongoing monthly savings behavior. So those are products that we could have theoretically offered through partnerships and gotten none of the economics from, and also not fully controlled that embedded experience in a way that we can do as a vertically integrated bank.
So I've heard you talk about this before, that LendingClub's core customer base is broadly composed of higher income individuals who are financially responsible. They carry debt, but they tend to have high FICO scores and are really looking to improve their financial health. So I'm curious what you can share with us about the resilience of this core customer base in the current market environment we're seeing, and maybe how that connects as well to sort of the broader financial health of the U.S. consumer populace.
Yeah, so we call our customer base the motivated middle. They're about a third of the U.S. population, but they're close to half of the U.S. credit wallet because they have enough money to afford stuff, but not enough to pay cash. So more likely than average to have pretty much every form of credit, and that form of credit is likely to be larger than average. So auto loans, student loans, credit card debt, all the rest. So they are, this segment we serve has the capacity to afford this debt. if you look at our typical use cases, they vary, but in general, we're helping them get more out of the money. So in the case of a personal loan, the largest use case is you've got the debt already, you're making your payments, you're current on everything. We're going to lower your cost of debt by 30% or so on average, 700 basis points. So we're just giving them more breathing room in their finances. We've seen, you had that COVID period where things were exceptionally benign from a credit perspective. After that, we went into this inflationary period that really, nobody had in their models because it hasn't happened in, decades and decades. And the impact on consumers was similar to a recession in terms of capacity to pay. So there was stress on credit back in, call it end of 22 into 23. We were one of the first people to see it. We were one of the first people to talk about it, to pull back. We had a lot of leading indicators that we were looking at. Cash balances of our consumers getting lower, prepayment rates dropping, extra payment rates dropping, reasons for delinquency changing. So we saw all that and said, hey, we're going to start to pull back and we're going to move up market. Since those changes, we've had several years now of very, very stable results. And we release all of that data as part of our quarterly earnings. What I'd say is it's very, very stable results. We're underwriting a very resilient consumer. Pause. That's not by doing nothing, right? It takes actual effort to deliver those stable results because credit's organic. Things are changing, people are changing, and we're reacting to that. So our platform, we're constantly, evaluating channels, segments, and adapting our model to reflect what we're seeing.
Something that's been really apparent about sort of the shift of the focus of the business in recent years has been going from kind of just this lending model to a membership model. And under your lead, the company has hit 5 million members and growing by focusing on those higher income strivers who use the platform for more than just a one-time loan. And so what have been some of the kind of key defining growth tailwinds at play there that you can recognize?
Yeah, it's really hard for a lot of people to understand the way kind of most Americans live. So if you just start with the fact that 50% of Americans are carrying credit card debt, right? Half. And you say, why is that? And can they come to us, lower the cost of that debt, pay off the debt, and then sail off forever into the sunset and never again be in credit card debt? That definitely does happen. But what also happens is life, right? So tree falls on the garage and you need to repair the roof. Whatever, your kid needs braces. You're moving across country. You're doing all of these things require a surge of liquidity, right? Extra cash, and that typically goes the most convenient way is to put it on a card. Although we're increasingly making ourselves available out of the gate. So we saw this repeat behavior happening and really embraced it. And so we've crafted an experience that really rewards our members for coming back by just being, it's magic. You come back, it's welcome back. Rachel, hey, are you still working at Motley Fool? Are you still banking with hopefully Lending Club or whatever? And great, you're pre-approved for this amount. Click the button, away you go. And we reward you with the rate, we reward you with a great experience. So what we see is on a monthly basis, roughly half of our volume is coming from people coming back to us for a second time. And if you come back a second time, it's likely you'll maybe even come back a third time. And we share the use case changes, right? Why you're coming back, what your need is evolving, but people do come back. And so we're really embracing that and trying to create this engagement platform that sort of keeps us in touch with customers, keeps us front and center, allows us to see what's happening with their financial lives, right? So they can bank with us, they can link their credit cards with us. We have a product called Debt IQ where that helps them see all their cards in one place, what their balances are, what their interest rates are, together with their other debt, right? And kind of manage and monitor that, because it's the only bill that people don't have on auto pay. So it's actually hard, and it changes every month, right? It depends on what your balance is, it depends what the interest rate is. So we help people manage all that, makes it easier for them to come back to us, and when they do, they come back, there's low to no acquisition cost, and they perform better. Lower credit risk for a like to like versus a new customer.
I wanted to talk a little bit about the partnership with WiseTech that your company announced in November, which WiseTech is a leading embedded financing platform for home services. And one of the things that really stuck out to me about this collaboration, it of course allows Lending Club to expand into the roughly $500 billion addressable home improvement financing market by leveraging WiseTech's extensive network. So I'd love if maybe you could share a bit more about this partnership and its various phases, and also how does the credit profile of these borrowers compare to your core personal loan members?
Yeah, so taking a step back on a personal loan is sort of like the original form of credit, right? You can use it for anything. We focused out of the gate, actually, we focused, back when I started, unlocking this, hey, there's this huge market which is existing credit card debt. Those people are easy to identify. Our value proposition is really strong. You have a loan, it's a terrible one. Do this instead. It takes 2 minutes, your FICO score goes up, and you save a bunch of money. Let's focus on that. And we crafted experiences around that to, help them directly pay off the debt and make it all very seamless. But that's not the only thing you can use a personal loan for. In fact, it's better to just not go into credit card debt in the first place. And when you have a planned purchase, go ahead and take out a personal loan. So we have what we call major purchase finance, just to distinguish from, let's call it the day-to-day BNPL players. These are big ticket planned purchases. I already mentioned some of the use cases: fertility treatments, braces, teeth implants, big considered purchases. And all of our core skills apply to this space, right? Our ability to effectively assess risk, underwrite, deliver a great customer experience, integrate with partners into their experiences to make it seamless. And so we really last year started kind of investing in growing that business. And frankly, we're beating our own expectations. We saw the market was really, really ready for the stable funding of a bank, because they've worked with a lot of fintechs who disappeared during the inflationary cycle and then are coming back. And so they like the stable funding of a bank, but what they don't like about a bank is an inability to flex, right? If your average customer FICO is different or your ticket size is different, how do we accommodate that in our policies and our model and our underwriting and work with you to get the customer outcomes you need? And so we unlocked a lot of distribution and growth last year and said, we're really going to push into other use cases, home improvement being one. And there, you can go sign enterprise deals with big partners like Anderson Windows or Home Depot. You can go to individual contractors, or you can embed in some of the software. And WiseTech, that's the path to market they've taken. We know the team really well. Former LendingClubbers are the founders. And what they bring to the table is an amazing experience for those counterparty software providers and the end users of it. And what we can bring is the ability to underwrite large loans at scale, and we have the funding and the capacity to hold those loans, right? And so it's a win-win really for both parties. We are in the process of integration now. We acquired a code base in the fall to give us some of the added capabilities that are required to serve this market. The ability to disperse over multiple stages, the ability to disperse to multiple providers. So in the process of standing that up and integrating with WiseTech, and we expect to be live, call it by the middle of the year. And that's the first partnership. Though there will be many more to come.
Very, very cool. It also seems like an interesting time in the kind of broader macro environment and specifically in the home improvement market to choose that as sort of one of your next frontiers to expand into. What was the thinking behind choosing that specific area as a mode of expansion at this point in time?
Yeah, there's a few drivers of that. One, you asked about the credit profile. These are all homeowners. In general, all things being equal, homeowners display better credit performance than non-homeowners, so that's a positive. They're also higher FICO. So these loans kind of have a reputation for being strong, performing well, and we think we can bring a lot to the market to help underwrite across a broader segment. So like the credit opportunity there, like the size of the market, the use case is very much on brand and on strategy. Before I was differentiating from, call it BNPL, we're not telling you to go into debt to get a burrito, right? We're basically saying there's like real logic in saying, hey, I don't want to save up to get braces for my kid. They're in middle school. It matters. Let's get this over for them. And
get it done now, yeah.
and the same thing is true with home improvement, right? There's real value for people in crafting their spaces. I'm sure people are staying in their houses longer. They have more equity in their houses than they've had before due to appreciation in home prices. And this market, based on the response of our public announcement, the number of inbound calls we got unsolicited from potential partners saying, we've been waiting for a partner like you for the reasons I articulated. We like the speed and flexibility of a fintech, but we want the stability and resilience of a banking partner. We can bring both to the table. So yeah, we're excited about the opportunity.
Something else that your company's talked about recently, and I've heard you comment on this, is this major rebranding effort that's planned for later this year. Lending Club, of course, now offers a full suite of digital banking products, and I know the goal has been to really be to move towards being that top of mind financial partner for a lot of consumers. So I don't know how much you can share, but what can you share about the rebranding and how this new identity will help the business really target your long-term growth goals?
Yeah, so I can certainly share the why and some thoughts on timing.
Sure.
So the why is, the brand of the company, Lending Club, was actually created to speak to the original business model, which was peer-to-peer lending, where Lending Club would go out, identify borrowers, assess risk, price risk. That loan would actually get funded by individual investors. They would invest $10,000 or they would put $25 into 400 different loans and they would build a portfolio of loans. It was a very innovative model and it helped the company get started at a time when, back to the point of there was no track record that you could convince a bank, a credit union, a private credit provider to invest in. But individual retail investors were willing to take the risk and got rewarded in those early days. So that was what the brand was, Lending Club. You're a retail investor, you join the Lending Club to invest your money into loans. That speaks less to borrowers, right? That model no longer exists. There's a lot of reasons why that was both not scalable and brought with it a lot of overhead and complexity. So that model no longer exists for us. And the brand, speaking to borrowers, it not only doesn't make sense, it's a bit weird. So, 60% of our checking accounts are coming from borrowers. Do you want to pull out a debit card that says Lending Club on it when you're paying for your groceries, right? It just feels off. It's the success we've had with our deposit initiatives. We have multiple awards for just a great deposit experience. We pay a great rate, but it is weird, right? You're putting your savings in Lending Club. So the new brand is really meant to represent what it is we do for customers and reflect kind of the scale of our ambition and what we want to mean to customers. We don't undertake it lightly. It is a big, we got to go through call center scripts and emails and a bazillion web pages and stock ticker. So we're in the process of cataloging all those and working on it, but we expect we'll be out with the new brand, sometime towards the middle of the year.
I'd love to talk a bit about what your business is doing with AI, because that's something I found really interesting as I was reading in anticipation of this interview. I've read that you have over 60 AI initiatives underway to improve efficiency, and that these AI models are informed by over 150 billion cells of data, and as you noted, have enabled 4 consecutive years of credit outperformance and resulted in 40% fewer delinquencies compared to traditional models. So I'd love if you could dive a bit more into how AI is being used across the business and where you're maybe seeing the most immediate ROI and efficiencies.
Yeah, so everywhere. And if you ask me in 2 weeks, I'll have an updated answer, right? It's moving really fast. I think we've done a pretty good job of, what started as a tops down has, quickly become a bottoms up. So we run, company-wide hackathons that everyone participates in, not just engineers, and mini hacks where businesses bring problems they want help solving. So marketing, compliance, operations, technology, product, audit. I literally had a presentation of how, we've built an agent in audit that's helping, make sure our reports are thorough and including everything, doing sample testing. So it's really across the company. Some of the stuff you talked about, if you talk about our credit and our models, we have dozens and dozens of models in use that drive our activity. Who are we advertising to? Where are we advertising? What are we saying in the ad? What offer can we make them? What questions do we ask them? How do we price it? How do we service it? All of that is driven by models. And, some of them are informed by advanced machine learning techniques. Other ones are really like fraud models, are really much more on the leading edge of, they're more dynamic using even the latest techniques. So it's really happening everywhere, and and also in the product experience, right? So, through DebtIQ, we're now going to be moving into helping people understand their transactions, understand their spending history using those features. So it's happening everywhere. I think it's a very exciting time. Very hard to say exactly how it evolves and where it goes, but the thing we feel very good about is it's not hard to project a little bit forward and say it's going to get easier for people to discover, right? One of the big things we battle is inertia in banking. It's like, well, my parents used Wells Fargo and I've banked with Wells Fargo my whole life, and they've been fine, and it's kind of a pain to change. And you're like, no, it actually isn't a pain to change. It literally takes 2 minutes, and you have $80,000 sitting in a savings account paying you 1 basis point, and, we can offer you 420 times that. Like, take the 2 minutes, do it. So, if you believe, as I do, that, agents are going to start proliferating and start enabling people to take actions, and you believe that those actions are going to help them identify ways to, get a better deal, improve their standing, we feel like we're pretty well set up to benefit in that world.
I want to talk a little bit about LendingClub's financials. In Q4, LendingClub held 23% of total loan originations for investment. The remainder were sold or earmarked for sale to marketplace investors. Have you found that to be sort of the sweet spot for the business? I was curious if you could talk a little bit more into the methodology there.
Yeah, so I would say, we typically hold somewhere between 25 and 40%. And, how do we decide? So one, it's a random allocation. We don't cherry pick loans for us, right? We take a random allocation or subset of the publicly available loans. And then we have some categories of loans we don't sell. So we do some small business lending that we hold on balance sheet. Auto refinance we currently hold all of. And our purchase finance business we hold all of. And then we have test programs, as I mentioned earlier. So there's the open market stuff, and we have our things that we currently keep for the balance sheet. Generally, over the last several years, we have not been constrained by demand by loan investors. The demand for the asset is high, at the yields that we've been able to consistently deliver. It's really been about our capacity on our balance sheet, and that's been, we're balancing earnings. So under the accounting, we've been under in the past, CECL accounting. You have to take the lifetime of credit losses up front the day you put the loan on your balance sheet, and you don't recognize the origination fee that you actually collected. So you take losses you didn't get, and you don't recognize the origination fee you did get. So in a higher loss unsecured consumer credit product, our losses are great versus the industry and in line with expectations, but it's higher than a mortgage, obviously. And so in a higher loss product, that's really punishing to your in-period earnings. So if you look back for us, you'll see historically, when we put loans on the balance sheet, our credit provision costs were really, really high. So we've had to balance, showing investors progress in our earnings with growing the balance sheet. We want to grow the balance sheet because we know that is one, the economics of holding are better than selling, and two, it is a more resilient form of income, right? When capital markets get risk off or, have a bit of a shudder, which they, regularly do, you can disrupt your loan sales process and the balance sheet continues to perform. So we announced at Investor Day we'll be moving this year to, what we understand is in line with most, if not virtually all of the new banks moving to fair value accounting, which allows you to sort of better align the timing. The loan economics are the loan economics, but the timing at which you recognize them adapts in a way that's favorable. And so we've indicated we plan to, over the course of the next several years, pick up the pace of balance sheet growth versus 2025.
Yeah, and that's actually something I was going to ask you about as well. I understand that transition occurred on January 1st. It's a technical transition that's designed to really align that revenue recognition with loan performance. But maybe you can explain a little bit more how that shift removes the day one provision penalty for loan losses and why it might introduce some short-term volatility but long-term tailwinds to reported earnings.
Yeah, so the big thing, just to make the math easy, if you took a $100 million loan portfolio on your books, and say, you expect the losses, the amortized lifetime losses, so you take sort of the day one amortized losses, let's say that's $5 million, so that's negative $5 million right there, and then you recognized $5 million in origination fees. Well, you don't recognize that. So under fair value on day one, you don't take those losses. So that's positive $5 million. And you do recognize the origination fee, less marketing costs. Under CECL, you can defer the marketing costs. So now you recognize the marketing cost and you take that out of the origination fee. So you have a positive swing on day one. But then what you do on day two is, since the cash flow of the loan is the cash flow of the loan, under CECL you took a super large hit up front. It means your day two revenue is higher. Under fair value accounting, your day two revenue is lower. That's basically the big difference. For us, we were under fair value for all of our marketplace loans. So we have let's call it $1 billion held for sale portfolio under fair value. Sure. And so this is just unifying our accounting across both. We think that'll simplify for investors, help us understand this portfolio over here. Oh, by the way, we had a held for sale portfolio under fair value. We also had a held for investment portfolio under fair value because we have, on a number of occasions, repurchased LendingClub loans from banks that got sold or banks that had liquidity issues. And so we had all these portfolios under different accounting methods. So this will unify that. And I think allow us to really, present a simpler financial statement that more cleanly aligns to what's actually happening in the business.
Yeah, thank you for diving into that more. That was something I definitely wanted to cover. We're in an interesting interest rate environment, shall we say? There's obviously the potential for rates to fall in 2026. So I'm curious, what areas do you see as maybe being your biggest growth engines if that is to occur? And conversely, if the Fed, pauses or hikes unexpectedly, how quickly can your underwriting models adjust?
Yeah. So maybe I'll start with, we feel good about our ability to deliver growth irrespective of the Fed's actions. I won't say irrespective of macro conditions, but irrespective of, Fed does or doesn't, we believe we'll be able to perform well. We're running still below our historical run rate in originations. We've got a lot of exciting initiatives on our roadmap, including the entry into the new space. Pause. The Fed lowering rates helps, and it helps in two ways. One is for our net interest margin. Fed lowering rates, we can lower the rate we pay on deposits, and therefore we get expanding net interest margin. So that helps the balance sheet. The expectation of the Fed lowering rates also helps the marketplace because buyers in the marketplace, their cost of capital is based on the future outlook. So if people think the Fed is going down, their cost of capital is lower, they will pay a higher price for the loan, and therefore we get stronger sales prices, stronger marketplace revenue, stronger non-interest income. So it is helpful, but not required.
What is your outlook on potential regulatory rate caps? This is something that we've obviously heard about a lot recently, and how maybe that upmarket borrower profile that you talked about could help protect the company from these shifts. Love to hear your thoughts.
Yeah, I mean, it's really hard to speculate given there's no specifics around what form this could take. I'd say we appreciate the push on affordability. Pause. That math doesn't math, right? A broad swath of customers cannot get unsecured credit at a 10% interest rate. Like it just,
right.
The losses won't support that. Never mind, the costs that the card companies have to support fraud, to support their rewards programs, to support, I don't see that actually working, and if again, depending on what form it took, I think it could be confusing, it could be disruptive. What I've seen till now, and we have several examples to point at, is most well-intended efforts on the regulatory front to lower costs to consumers have not resulted in lower cost to consumers, right? Dodd-Frank changed the way credit card companies could adjust rates, right, and restricted how they could adjust rates on balances. What did they do? They just raised rates on the balances because they lost the flexibility to do it. So they just raised rates, which is one of the reasons why rates are so high. There was rumors of CFPB coming in and capping late fees. Well, what did they do? They raised rates again, right? It's the margin that, I don't see the credit card companies willingly compressing their margin. And so we're sort of in a bit of a wait and see mode. I think, hopefully people are very thoughtful about, how do we support the push on affordability, but also recognize the implications for, what it means for the economy, which is so driven by consumer spend. I mean, we'll be here if people need access to credit, assuming at least the way it's talked about now, the rate cap is on credit cards, we'll be here and couldn't provide that access. But I hope some real thought is given into what this would look like, because I think it could have some real unintended consequences for the consumer and the economy more broadly.
Yeah, I think that's right. I want to talk a little bit about the competitive landscape for LendingClub. I'm curious who you consider to be your primary credit competitor today. Is it regional banks? Is it other fintechs? What's your mindset as it regards that?
Well, the first is, who are we taking customers from, right? And that's the credit card companies. So think of the top five. There was a time back where one of them had a counter on the wall that was counting all the customers that Lending Club had stolen, because we are taking the most profitable customers from cards, right? The most profitable customers are the ones who carry a balance, and we are taking them out of the portfolio. So that's one. Then two, within our space, we cover a broad range of credit. While the average consumer we serve, fits the motivated middle profile we talked about, we go all the way down to 600 FICO. We don't hold a lot of that on our balance sheet, but we serve from 600 all the way up to 850. So where in the FICO spectrum we are dictates a little bit of who the competition is. At the top of the market, it's credit unions and banks. Kind of in the middle is more fintechs, and at the bottom is more, let's call it some of the branch-based OneMain and those kind of players. And then it also depends on where we are in the cycle of the market. So fintechs we're relentlessly, including us, we're relentlessly taking share. Rate environment spiked. Fintechs all pulled back because they did not have their own capital to deploy. Banks gained share, so we're competing more directly with banks. As the rates have dropped, I think banks are losing share again. We're competing more with fintechs again.
I want to talk a little bit about growth expectations for the company too. So you've guided for $1.65 to $1.80 earnings per share for the full year 2026, a significant jump from 2025, anywhere from 42 to 55%. What do you look at being as your most significant growth levers as we're going into this new year, and of course beyond that?
Yeah, so one is marketing vehicles. So what we talked about was we pulled back in that rate during that high rate cycle. We had the same implications on our marketplace. Our balance sheet powered through, became a bigger portion of our revenue because our loan marketplace revenue got constricted. So we pulled down volume, pulled back on marketing. We really, over the course of last year, you saw in Q4 we grew 40% year on year. Part of that is we're simply turning back on marketing vehicles that we had turned off. So direct mail, paid search, paid social, all those things. So that's a driver. I'd say a second driver is our experiences. So we showcased at Investor Day some new thing. Back to AI. New use of AI is, for the most part, our loans are fully automated, right? You're looking at 80 to 90% where no humans touching it. But there is a subset of where we require something from the borrower because we can't do it electronically, right? We can't assess your income, identity, employment in a way that we can do on our own, so we need you to provide something. That's often a document, a couple of pay stubs, your driver's license, whatever. So, using AI to say, when they upload that, rather than a person, working a queue of documents, AI to say, is this actually the document we requested? Is it real and not fraudulent? And can I pull the information out of it that I need to populate the models and move the process forward? We started testing that in Q4 of last year, are very encouraged by the results. We were also doing other kind of anything to remove funnel friction, ways of populating for our customers. When you come in for a loan, let's just show you your credit cards and show you what your balances are and make it easier for you and say, hey, do you realize you've got 6 active cards, each of which are holding a balance? And so, and do you want us to pay those off for you directly? So we have a lot of innovations like that just help the customer get through the process easier, or less friction. And then we have the new products we're growing. Auto refinance with the rate environment where it is. When rates shot up, that business is not as attractive, right? If you tried to refinance someone after rates had gone up 500 basis points, you wouldn't be able to offer them much value. But as rates have come down, we can offer value there. Our purchase finance business, as we mentioned, is growing at very strong double digits. And then we've got the new home improvement initiative. So we have a lot of different initiatives that we're confident will drive growth.
If a major competitor tried to copy your company tomorrow, where do you think they would fail first that Lending Club is primed to succeed?
Well, we have several prominent examples of that. This is one of those areas that I say it's like yoga. It looks a lot easier than it is. We've had several examples of people coming in, and in some cases coming in multiple times, trying to compete directly with us. You brought up before, we've got $100 billion worth of loans over multiple cycles, over close to 20 years, powering dozens of models. You can't just show up and think you can compete directly without any of that information, and that you're going to properly assess risk, and you're going to get it right, and you're going to have the same pull-through as we do on the process. So it is much more complex than it looks, and it's a very competitive environment. So, we just saw a Genius Bank pull out of the U.S. market. They came in and, built a portfolio of personal loans. Marcus is another pretty visible example that, came in, guns blazing with a lot of resources behind them, and, had to, sort of skin their knees learning in market. So what I'd say is we're very, very good at knowing which customers we want and bringing those customers to us. And so I think it's quite difficult for newcomers to compete in that market.
One final kind of two-part question for you before I let you go today is, if everything breaks right, what does your company look like 3 to 5 years from now, and what do you see as being sort of the most significant drivers of that growth?
3 to 5 years from now, we'd like to be a household name, viewed by consumers as, actually a bank that makes it easy for them to do the right thing and improve their financials. We have a broad range of consumer credit products that, help them manage their debt responsibly and actively, and continue on the growth path that we're on today. We gave at Investor Day that we expect over this time period to continue to grow originations 20 to 30% every year, and to achieve call it ROTCEs in the high teens.
Awesome. Well, thank you so much, Scott, for joining me today here. It's been wonderful to speak with you, learn more about Lending Club and all that the company is doing. It looks like there's a lot for investors to be watching.
Great. Thank you.